Welcome back to Iron Financial. Look, when the broader market starts crumbling and the macroeconomic foundations look, frankly, really shaky, you don't go looking for a temporary tent to hide in. No, you look for a reinforced bunker. Today, we are running an absolutely ruthless stress test on one of the most storied balance sheets in the entire world, Ferrari. We're going to dive super deep into their Q1 2026 earnings release, dissect their 2025 full-year metrics, and review the absolute latest analyst notes. We need to see if their financial architecture is built out of solid steel or, if it's just a shiny luxury facade that's ready to crack under pressure.
Okay, hold on just a second. Let's set a reality check right out of the gate here. We are talking about a luxury asset class. When the global economy gets brutal, when supply chains fracture and everyday consumers are feeling the absolute pinch, can any luxury automaker truly survive the heavy lifting required? Is Ferrari actually immune to the cracks forming in the broader global economy, or is this just elite hype masking a highly vulnerable foundation? Because frankly, that is the definitive question every retail investor needs answered before they even attempt to lift this stock into their portfolio.
Let's get right into it. Section 1. Forging the Foundation.
That question is exactly what we are here to inspect today. We need to check the structural integrity of this company's operating mechanics right from the ground floor up. We aren't looking at the flashy paint job today, we're looking at the financial rebar and concrete that keeps this massive operation standing while its competitors are aggressively scaling back. Take a look at the Q1 engine that's actively driving this machine. Net revenues literally forged ahead to an incredible 1.848 billion euros for the quarter. To put that into perspective, that is up 3% versus the prior year. And actually, scratch that, it is even more impressive when you look at it in constant currency. It's up 6%. This fundamentally proves that this company is not just hype. They are generating massive load-bearing top-line revenue, and it's being driven by a significantly richer sports car mix, higher personalizations, and a brilliantly strong country mix across their entire global footprint.
Okay, I'll admit 1.84 billion euros in revenue is a really nice top floor. But I need to drill down on the raw numbers. What does the foundation actually look like when you strip out all the noise, remove the marketing flash, and just look at the sheer profitability? I'm so glad you asked, because the solid foundation is right in front of us. They delivered a massive 722 million euros in EBITDA. For anyone looking at the raw foundation of a business, EBITDA is your core operational cash flow, before the accountants step in and muddy the waters with interest, taxes, depreciation, and amortization. That EBITDA metric is up 4% year over year, or a massive 9% at constant currency. And their EBIT, which is their operating profit, basically the actual profit the business generates from its pure day-to-day operations, stands incredibly firm at 548 million euros.
But honestly, the number I really want to hammer home today, the absolute metric that should make any serious investor pause and pay attention, is this: 39.1%. That is their EBITDA margin. Think about the gravity of that for a second. A nearly 40% margin for an industrial automaker that is physically bending metal and building incredibly complex engines, that is practically software-level profitability. You usually only see these kinds of margins in massive tech monopolies, definitely not in automotive manufacturing. This kind of margin acts as pure steel reinforcement against market shocks. It gives management the massive shock absorbers they desperately need when input costs fluctuate or when global trade gets severely turbulent.
And if you really want to talk about the actual concrete holding this entire financial portfolio together, just look at the industrial free cash flow. They generated an astounding 653 million euros in a single 3-month quarter. That's up 5% versus the prior year. This robust cash generation is heavily sustained by their immense profitability, expert timing of cash collections, and a highly positive net effect from customer advances on those highly anticipated hypercars. This isn't some theoretical paper profit that exists only on an income statement. We are talking about cold, hard liquidity actively pouring into the foundation of their balance sheet.
Moving on to Section 2. Calculated restraint? Let's analyze volume versus value.
All right, let me interrupt you right there. You are painting a picture of an indestructible financial fortress, but my job is to find the hidden cracks in the armor. So I want to talk about the physical factory floor. Q1 deliveries were deliberately lower at exactly 3,436 units. That is a tangible, measurable drop from the previous year. Because revenue increases driven solely by aggressive price hikes, well, they can only mask an operational decline for so long. You really have to ask yourself, is the company secretly bleeding volume demand? Are they masking a lack of underlying buyers by claiming this drop is quote-unquote deliberate?
No way. That assumption completely misunderstands the architectural blueprint of this company.
Let me shut that concern down right now by comparing this flat volume directly against their value over volume strategy. This deliberate restraint is a calculated blueprint to protect those world-class margins we just talked about. They purposely designed their deliveries to be slightly lower to flawlessly execute a highly planned model changeover phase. While shipments of older models like the Roma Spider and the 296 family predictably decreased, high-value models like the 12-cylinder family, the Puro Sangue, and the SF90XX actually increased. So no, this isn't a company bleeding volume. It is highly calculated exclusivity. In fact, their order book already extends toward the end of 2027. They have way more demand than they even know what to do with, but they absolutely refuse to flood the market and dilute the brand.
Furthermore, look at how they purposefully engineer these structural reinforcements to mitigate severe market shocks. You brought up global macroeconomic turbulence earlier, which is fair. But total deliveries were completely unimpacted by the surge of hostilities in the Middle East because Ferrari leveraged its massive geographical allocation flexibility. They simply bypassed the disruption by bringing forward guaranteed deliveries to other, more stable regions across the globe. Combine that operational agility with the highly successful F80 supercar ramp-up phase and the undeniable ongoing strength of the Puro Sangue, and you have a financial foundation that fundamentally adapts to stress rather than cracking under.
Section 3. The heavy lifting. Let's look closely at the year-over-year revenue bridges.
We need to see exactly what product lines are providing the tensile strength here. Let's dissect the revenue bridge line by line, looking back at the full year 2024 to 2025 trajectory that really set the absolute bedrock for this quarter. Cars and spare parts naturally provided massive base support, growing 5.7%, but look at the incredible scaffolding built completely around it. Sponsorship, commercial, and brand revenues spiked by an unbelievable 23.4%. We are talking about higher-tier sponsorships, significantly improved Formula One rankings driving much bigger payouts, massively expanded lifestyle activities, and even the lucrative rental of physical engines to other global racing teams. This added massive, high-margin structural support to the top line that most traditional automakers simply do not have access to.
And what's driving the unprecedented margins inside the actual vehicles themselves? Using the steering wheel as a metaphor for absolute control, let me explain how Ferrari essentially prints margin. The massive, insatiable demand for personalizations and their tailor-made programs forged an incredibly rich product mix. Buyers are no longer just buying stock off-the-line models. They are eagerly paying massive, heavy premiums for bespoke interior finishes, extensive carbon fiber detailing, and highly exclusive colors from their brand-new, state-of-the-art paint shop. Every single customization they add pushes the gross profit per vehicle right through the roof, adding pure steel to the bottom line, without needing to sell a single extra car. Let's explicitly detail the exact elements padding the bottom line inside these margin forges. We are looking at an exceptionally strong America's geographic mix, an incredibly positive product mix driven heavily by the SF90XX and the new F80, and higher overall racing revenues. On top of all that, they secured a massive structural benefit from the new patent box tax regime. For those newer to the mechanics of international taxation, this specific regime provides a 110% super tax deduction for eligible and tangible research and development assets. That brilliant maneuver effectively pushes their corporate tax rate down to just 23%. Okay, sure, but let's not completely ignore the deadweight acting as headwinds here. They are facing higher depreciation and amortization, or D&A. That is essentially the massive, unavoidable accounting costs associated with physically starting up production lines for brand new models. Combine that D&A with drastically higher global marketing expenses, heavy U.S. import tariffs, and the notable absence of the highly profitable Daytona SP3 deliveries, and well, that is a massive amount of weight bearing down on the beam.
Those particular headwinds are functionally nothing compared to the sheer, raw cash flow lifting the entire structure. Let me emphasize a massive structural shift on the balance sheet that absolutely proves my point. Look at this net industrial cash position, a staggering 388 million euros in the green. Think about this. At the end of December 2025, just one single quarter prior, they were actively sitting on a net debt position of 32 million euros. In a single 3-month period, while actively executing millions in share repurchases, they successfully flipped from carrying net debt to sitting on a massive net cash surplus. That is the literal definition of forging an unbreakable, heavily armored balance sheet.
Let's move to Section 4, the valuation stress test. Is this premium actually justified? The balance sheet is undeniably fortified. I will completely concede that the operational financials are steel-clad, but we have to transition and talk about the actual cost of buying the stock today. Is the premium simply too heavy for retail investors to lift? Because a fundamentally great company does not automatically equal a great stock if the entry price collapses under its own massive weight.
I will counter those valuation fears right now by dropping this massive shareholder reward right onto the table, a 640 million euro dividend payout. That is an increase of approximately 21% compared to the prior year. And if a massive dividend hike isn't enough to justify the premium to you, consider the ongoing 3.5 billion euro share buyback program. They just launched the second massive tranche of up to 250 million euros starting in April 2026. Management is actively, aggressively fortifying the share price by returning staggering amounts of capital directly to the actual owners of the business.
And the architectural blueprints for future growth are fully approved and permitted for construction. Outlining the officially confirmed 2026 guidance, management strictly expects net revenues of roughly 7.5 billion euros and an adjusted EBIT margin of greater than or equal to an astonishing 29.5%. This heavily fortified guidance is built on significant planned model changeovers, massively expanding lifestyle activities, and higher racing revenues across the board. Furthermore, with the highly anticipated world premiere of the Ferrari Luce only 20 days away, which is going to bring extraordinary, previously unseen technologies to the market, management essentially cements the fact that top-line growth and free cash flow will remain absolutely rock solid for the foreseeable future.
But look at the multiple. We are looking at a 42x forward PE ratio, or even a 38x short-term multiple on the absolute best estimates. As a true market skeptic, I demand to know, is paying this kind of nosebleed, heavily inflated multiple a dangerous value trap for the everyday investor? When the macro environment crumbles, high multiple growth stocks are traditionally the very first asset class to get completely crushed. Is this highly priced stock simply going to snap under the immense pressure of its own lofty, perfection-priced expectations?
To justify the multiple, I'm going to reference the latest institutional WebSim report, which just aggressively raised their target price on the stock to 491 euros. Here is the undeniable architectural reality of why that multiple actively holds up under pressure. You aren't paying for stagnant unit volume. You are paying for a massively expanding average revenue per unit, or ARPU. That ARPU metric is actively expanding above 450,000 euros per vehicle. That is a staggering, jaw-dropping 41% increase in absolute terms just since 2022. With 13 distinct models successfully launched and the highly anticipated Electrica models set to be unveiled at the upcoming Capital Markets Day, that 491 euro price target is built on a very solid, incredibly dense foundation of compounding revenue.
Section 5. The final verdict. Is it a trap or an opportunity?
All right, we've thoroughly inspected the bedrock of their cash flow. We've aggressively tested the load-bearing columns of their margins, and we've heavily stressed the valuation multiple. It's time to deliver Iron Financial's final verdict. I'll concede the structural integrity of the entire argument. I came into this analysis looking for hidden fractures in the balance sheet, but the highly deliberate volume restraint, the massive compounding personalization premiums, and that $653 million in raw quarterly free cash flow, it's just too heavily fortified to deny. I have to openly admit that the value over volume strategy has forged an undeniable, heavily defended moat around the luxury brand that seems uniquely, highly resistant to broader consumer weakness and macroeconomic panic.
And that ultimately brings us to the final word on today's stress test. This isn't just a traditional industrial automaker. It's a high-margin, fiercely protective, cash-generating luxury fortress. With a solid and rapidly growing dividend, a massive multi-billion euro share buyback program, and an absolute iron grip on pricing power that expands their revenue per unit to unprecedented heights, this represents the absolute highest grade of financial engineering available on the public markets today. I challenge you to look closely at your own current holdings right now and ask yourself, when the macro environment gets incredibly heavy, when inflation bites hard, and the broader market inevitably starts crumbling, is this cash-generating, steel-clad machine the exact structural beam your portfolio desperately needs to cut through the weakness?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.